ladies and gentlemen, and welcome to Canaccord Wealth's Autumn Market Update webinar, one of our regular series of webinars. There will be ones for those of you interested around the UK budget towards the end of November as well, so look out for those in your invites. Welcome as well to clients new and old, and for those who are quite new, I thought I'd just recap who the two leading people here are in terms of what we do and our name. So I'm Richard Champion. I'm one of the co-CIOs with my esteemed and good friend colleague, Tom Becket. Tom joined Canaccord just over 3 years ago. I've been here just over 10 years. And when we got together, we have completely refreshed the investment process, which I think has been borne out by some better performance. Tom's responsibilities are broadly fixed interest, which he'll talk about at length today, and model construction. And I am equities and more tailored portfolio structuring. As normal, we will kick off with a Q&A style presentation format, and I try and address the key issues of the day. So without further ado, I'll hand over to the main section of the presentation, and I'll start asking Tom some difficult questions on macro and fixed interest. Tom, it's been a remarkably turbulent year for geopolitics. Politics have been incredibly volatile themselves. Just look across the channel at our friends in France. And obviously with Trump and tariffs, there's been a lot of economic uncertainty too. And yet portfolio returns have been actually very good this year. What's going on?
Well, firstly, I think that's the nicest you've ever been about me in the introduction. So we'll see if we can keep up that spirit for the next 45 minutes. I suppose some of it might depend on my answers, but you're right to point out it has been an extraordinary year. And I think that let's just go on a brief history lesson to set the context for what we've seen in 2025, because investors of a sort of longer time frame will recognize that in the 2010s, or the easy 10s as we described it, it was a golden age for portfolio generation of returns with low volatility. The world was a much more predictable place. We had an era of low but positive growth, low but positive interest rates, low but positive inflation, and strong asset market returns. As we got towards the end of the last decade, I wrote a piece about the turbulent 20s and about how this decade would be somewhat different, in inverted commas. And it has proven to be very different on many different matters. There's a lot less predictability than there was. But broadly, the tale of the turbulent 20s so far has been a concerning, fraying geopolitical backdrop, political uncertainty, societal discontent, economic uncertainty, volatility around inflation, interest rates going down and then up really quite considerably. But asset markets have carried on producing positive returns. Now, this year has really been the most, the best example that we've seen of a turbulent 20s year. You're right to point out, and every client asks us, how has it been possible to produce really positive returns when we've seen all those complicating factors which have summed up the turbulent 20s so far? And in very simple terms, Richard, you just needed to keep it simple. You've needed to ignore the noise, ignore the political nonsense, and focus on the facts and those fundamentals. And actually, this year hasn't been too bad from an economic perspective. It's not been spectacular, but it's been perfectly solid. And actually, for all the talk of a US recession back in the first quarter of this year, the last 6 months in the US economy has been much stronger. Perhaps more on that in a minute. Whilst at the same time, we've also seen a situation where inflation's a little bit problematic. Again, more on this in a minute, but it's not disastrous, and it's nowhere near it was a few years ago. And at the same time, we're starting to see interest rate cuts in the US accompany those that we've seen in the UK, Europe, and other markets around the world. And I think in very simple terms, whilst these three big building blocks around the global economy, inflation, and interest rates are not negative, that's allowed companies to keep on generating good profits, and that's allowed companies to avoid defaulting, both of which have been good for portfolio returns in equities and fixed interest. So again, ignore the noise, ignore the nonsense, keep it apolitical, and you recognise it's been a pretty decent year.
It has, and that's a nice environment. It makes our jobs easier and makes our clients happier, which is good. More to follow, do you think? Is this going to continue on this kind of fairly good environment for returns?
Well, it's not a competition, but I've been investing now for well over 20 years, and I think Richard's been investing for slightly longer than that. We always recognise, Richard, that whenever things have been good, there is always the chance that things are a bit less good in the intervening following period. And I think there is a bit of a case for that here. I mean, I think we would argue in the very short term, things have become a bit overheated. Things have become a bit more complacent. I'm sure we'll bring that to life as we talk about valuations later. But again, let's just focus in on the simple facts. Okay, as we head into 2026, we're likely to see an environment where economic growth should be positive. And if you follow the tail of the markets from the last 6 months, which have performed extremely well, with certain cyclical and economically sensitive companies performing quite well within the stock market, that's normally an indicator that economic activity should continue to be relatively sound. I mean, you could argue, as we go on to talk about the US in a minute, that President Trump is on a more pro-growth footing, and that could be good for global economic outcomes. At the same time, the problems that we're currently seeing in the UK around inflation, with all of our various bills going up, that those problems, please don't hold me to this, but this is our forecast, should start to dissipate by the time we get to the end of the year. In the US, we're expecting to see something similar, which will mean we will see a few more interest rate cuts. And when you combine that with the same factor that we've seen through this year of companies carrying on delivering good profits, we should expect more of the same. Now, the one thing to recognize is that quite a lot of this is now priced in. We're a long way away from the misery of 6 months ago when markets were performing poorly. People were talking about a new bear market. All of this was complete nonsense, of course. Things have been actually very good in the last 6 months. But we need to recognize a lot more people are now more positive than they were. So we're expecting positive returns, albeit with a great deal of volatility.
That's good news. You alluded earlier to the Fed, the US Federal Reserve, cutting rates after a long period when it was sitting on its hands, whereas the UK and Europe have been cutting rates during the year already. Just as we go forward, there's a sense that maybe the UK is going to go on pause now while the US continues down. And given how difficult the UK economy appears relative to the US one, why isn't the Bank of England actually going to follow through and accompany the Fed on cutting rates in the second part of the later part of this year?
I think we need to keep open-minded, and we'll come back to the UK in a minute. It's very important with our portfolios and with financial markets generally not to become too parochial. And I appreciate lots of people on today's call are interested in interest rates and what's happening in the UK economy and worryingly UK politics. We'll come on to that in a minute. But it is absolutely right from your portfolio perspective that we focus more on what the US is doing. This is absolutely key. So a couple of comments on the US economy, first of all, and then we'll lead it into the outlook for US interest rates. So if you go back to the end of the first quarter, US economic growth was weak, contributed in no small part by the very cold winter that we've talked about before on the eastern seaboard, which impacted economic activity. But also the Trump administration's first acts were all on balance growth negative, pursuing government efficiency, which I think we can all agree we could do with some of that here in the UK, but focusing on that was a growth negative. Focusing on immigration has been a growth negative for the employment backdrop. They're creating fewer jobs. And also things like the tariff pursuits, which were unpopular with financial markets, but also not good for economic growth. Those days have shifted in some way. The pursuit of government efficiency has been shelved. While the immigration pursuits continue, we're also at the same point when it comes to tariffs that the world and markets have at least temporarily moved on. So the US growth backdrop is better than they were suspecting. But in the US, there are two sides to the central bank's mandate. In the US, they have to focus on unemployment or full employment, as well as price stability. Now, price stability is actually a 2% inflation rate, which lots of people point out is not price stability. But anyway, bear with me on that front. And for a long time, Richard, particularly exacerbated by the problems around the potential increase in inflation because of tariffs, the Federal Reserve resisted putting down interest rates or cutting interest rates like President Trump really wanted them to do. We can't do that, Jay Powell said. There's too much uncertainty, prices are still high, and the tariffs could add further fuel to the inflationary fire. Now, what we've seen in the last few weeks and months is the US employment backdrop has become less positive. And part of this is in no small way down to the fact that Trump has closed the southern border, and you're no longer creating a whole new load of new jobs every single month through the immigration into the US. Now, longer term, this could be negative for economic growth in the US. At the moment, it's just a minor negative, I would suggest. But the employment backdrop is less positive than it was. Jobs are harder to find. And if you lose your job, you're likely to be unemployed for longer than you were only a couple of years ago. So Jay Powell, the chair of the Federal Reserve, and the Federal Reserve together have decided that they should start cutting interest rates because the employment backdrop has worsened. And as you can see on this chart here in front of you, the red line on the inflation rates, inflation's ticked up a little bit, but it's by no means a major problem. Certainly by comparison to 2021, 2022 and the start of 2023, inflation is not a big problem. And inflation is expected to roll over further by the end of the year. So the Fed is now confident in cutting interest rates because it believes it needs to support the employment market, which on the right-hand side here is going to lead to probably 3 interest rate cuts in the US between now and this time next year. The markets are pointed towards more like 4, but we think it'd be more like 3. So that's why the Federal Reserve is cutting interest rates. Now, in the UK, we're in a slightly different position because the Bank of England does not have a twin mandate of full employment and price stability. They're really obsessed with the inflationary dynamics in the UK. And as you can see on that same chart as the red line, the white line is more problematic. This is the UK inflation rate, and it's going to be at about 4% when we see September's reading. Now, this will also start to come down, but not down to the 2% level that the central bank is targeting. So unfortunately for the Bank of England, it's caught between the rock of rising inflation and stubbornly, persistently higher prices, and the hard place of a negative economic scenario. So it does not have the cover to cut interest rates like the US Federal Reserve does with its twin mandate. That being said, we would still expect one more interest rate cut from the Bank of England before interest rates settle somewhere between 3, but more closely, we think, to 4%. So it doesn't really have the same support as we move forward. That's why we're seeing the difference in the central bank's focus.
Thanks, Tom. And look, we mentioned that we mustn't be parochial, but we all, well, most of us live either in the UK or close to it. And we are bombarded in the press by how dire the situation is in the UK. What does that mean for our portfolios? And of course, we've got a budget coming up on the 26th of November. What can Chancellor Reeves do about it?
So clearly the reason you're being nice to me in the introduction was because you knew what the questions were coming, and this is a particularly thorny one to have to deal with. So let's talk about the less thorny side of things now. Let's talk about the portfolio impacts of what we've seen so far this year. And in fact, actually, it's been the case ever since I came to Canaccord from the company that was acquired by Canaccord a few years ago. It's been the same thing in fixed interest markets all that time. It's been a great opportunity to make positive returns from fixed interest, as long as you've avoided the white line here, which is UK gilts. They've been a disastrous investment for the last 3 and a bit years. And a lot of this goes down to the inflation situation we've mentioned, the inability of the central bank to cut interest rates like they want to, the miserable economic scenario and stagnation that we've seen in the UK for, frankly, many years. And of course, the fact that our government, be it of the Labour variety or indeed the Conservative variety beforehand, is not well trusted by international markets. So this year, from a portfolio perspective, Richard, it's been actually a really positive time to make positive returns from fixed interest, as long as you focused in on those areas which have produced the positive returns and avoided UK gilts. But that's the easy part. You know, what about the more difficult bits as we look forward? The UK is in a particularly difficult position because of the approach our government has taken and some of the mistakes it's made. And I would argue that as we head into the budget with the prospect of further tax rises, which are necessary, because if we look at the bar chart on the right-hand side, you can see that Chancellor Reeves has once again run out of money. In fact, they never actually have any money. It's just a case of how much more debt they've issued, frankly, these days, as opposed to real revenue generation, which used to be the case. But the Chancellor has no breathing space whatsoever. So they have to raise interest rate. They have to raise taxes. And on the left-hand side, if you see something called the Laffer curve, or the UK tax burden, what this shows is the UK tax burden is now as high as it has been and is likely to be higher than it's been since the end of the Second World War in the coming months. And this is impacting consumer confidence, impacting corporate confidence. And in terms of the Laffer curve, that means that you've gone past the point where tax rises become a negative rather than a positive in the form of overall growth and economic outcome. And that's where we find ourselves now. I mean, the big question is as to what Chancellor Reeves should do next. And this is a really difficult situation for her to have to deal with. And I have some sympathy because, as we said a year and a half ago, this was an election to lose. We're in a very difficult financial situation in the UK, but we also must admit that the Labour government has compounded the issues and made the problem worse for themselves. Just in terms of the current debt situation, you can see that since the end of the last decade, we've raised more debt as a percentage of GDP than any other of the big G7 nations. This is not good. I want to compare us, though, to the US, which is also raising debt at a heroic rate. But they are going for pro-growth policies. They are looking for government efficiency. They're looking for economic efficiency. They're looking to spur research and development in the economy. The Trump administration is going for growth. That's why US assets, I believe, have performed really well in the last 6 months. In the UK, it's a bit different. I believe that we're pursuing a negative growth environment, which is impacting confidence and is creating a problem. Now, what I would really like to see, as I think we all would, is much more investment in the country through research and development, investment in the young, investment in education, and get the economy moving forward on a longer term timescale. I don't think we've really got that breathing space, and I think that's part of the problem. So you might say, well, what is the government going to do to try and balance the books? Now, I think, and this might be controversial, that they should just go about raising income tax across the board, so everyone pays it by a couple of percentage points. That will help to balance the books to a certain extent and reduce down the pressure on Chancellor Reeves. But my suspicion is they won't do that, and rather they'll try and fiddle it and fudge it, and we'll be back here again in only a few months' time. So a portfolio perspective, we still like fixed interest. We're a bit more positive on UK gilts because the yields are higher, but that is still an area of a source of discomfort for international investors.
So moving on to fixed interest, which, as I mentioned at the beginning, is your specialist subject, if I could put it that way. Outlook for the current next 12 months or so in terms of a solid period of returns, nice returns from particularly some of the areas we focused on. Do we see this continuing?
Yeah, and I'll be quite brief on this because I want to ask you particularly difficult questions on equities. But I feel very simple on fixed interest. The environment we described of solid but unspectacular growth, corporate profitability, not very many corporate defaults, if many at all, in all honesty, alongside subsiding inflation and interest rate cuts. I mean, that should be really a positive environment for fixed interest, particularly given that yields are higher than they were a few years ago, even if they've come down a bit in the last couple of years. So I would argue on balance that the next 12 months should be positive from fixed interest. We're going to see volatility. There'll be problems and sources of discomfort like in the UK from time to time. But overall, we remain positive and we're still hoping to achieve that outperformance we've managed in the last couple of years. So that's quite enough of me. Odie, Richard, but I am going to pay you a compliment because as we've gone around the various different offices in the UK and seen lots of our clients in the last couple of years, we've talked about the concentrated nature of the equity market's return. But see, this year's been a bit different, hasn't it? This year, we have seen the market broaden out as you expected to, both in terms of regions, but also in terms of some of the sectors beneath the bonnet of markets. So perhaps you could talk us through that and what we've seen.
Yes, this year has been much more healthy in terms of the spread of returns. I don't feel comfortable, and it's very difficult to actually invest on behalf of our clients when the returns are only made by a handful of names. And that's what happened in 23 and for most of 24 as well. This year, we have seen a broadening out. And that, as I say, is very encouraging. Firstly, because it sort of plays to something I've banged on about a lot, which is that valuation comes out in the end, by which I mean if something is cheap, eventually people will begin to focus on it. And that's very much what's happened in geographical returns from Europe, for example, Japan more recently, beginning in emerging markets as well. So that's very encouraging to see a much broader spread of geographies, because it was all led by the US and the Mag 7 previously. The US, it hasn't been a slouch actually this year. After a horrible start, as we know, we had the call just after the Trump tariff turmoil in early April, where we sort of said we felt that the market was going to recover. It did, perhaps more aggressively than we anticipated. So the US has also participated, but they've been held back in terms of a UK-based investor by the weakness of the dollar. And that dotted yellow line at the bottom is what the dollar index has done over the year. And you can see that against its major currency pairs, it's down 10 to 15% over the year, which is a big move down. And all the charts above are in the common currency. So it's very encouraging, though, to see from the geographical point of view that low valuation areas have begun to participate, which is a rational thing that we'd expect. Took some time to get going, but it certainly happened. And amongst those, we just talked about how grim the outlook is for the UK. And indeed, we could have talked about how grim the outlook was for France, for example. Amongst those, you can see at the top, in the lighter blue and the greeny blue lines, that's the UK and Europe this year, leading the way, despite the bad economic backdrop there. And that is to do with the valuation of the markets at the beginning of the year. So that's super encouraging for a broader and better outcome for our clients.
Yeah, and I think it's important. We found out, a reminder yesterday on a call with one of the fund managers we employ within our portfolios. He pointed out that the equity markets is not the economy, and certainly the equity markets are not a reflection on governments and politics around the world. They're a reflection of companies, their valuations, and their success at generating profits. So we always must remember that as one of the tales for investing. And again, another reason why you ignore the noise and ignore the nonsense and focus in on the fundamentals. But let's go back to some of the noisiest part of the year, and I'll contradict myself here. And let's go back to April. And you remember, Richard, various different Easter holidays were majorly disrupted. The news flow and the news cycle was full of global recessions, global bear markets, the end of US exceptionalism, all those various different things. But since then, we've seen one of the fastest rallies ever in the US equity market, which I think is up some 35% since the April lows. And I think only surpassed in terms of recovery by 1982, 2009, and 2020 after major corrections, which is really giving it some esteemed company. So in terms of what we've seen through the last 6 months, what's that telling us perhaps about the economic outlook by the shape of the recovery we've seen and some of the companies and sectors which have performed best?
Yeah, I mean, look, I think the core point to make is that this shows that the economy, the broad global economy in the background, is, as we said right at the beginning, is doing okay. We also have to acknowledge that there is this super trend, if you like, a super cycle going on in technology, particularly surrounding artificial intelligence, which has also helped broaden the sectoral mix. But here you can see that actually technology in white has not led the way, and indeed, despite a very strong recovery from those April lows, as we said, it is communications which is doing better. Communications being the sector in which things like Meta are, so very much an AI play there. But encouragingly, financials being very good. Financials typically benefit from a lower interest rate environment, and they have. Utilities also benefiting from lower interest rates. But also in their case, of course, because people are worried there isn't enough power to being generated to power the AI data centers. So they've become a focus for the AI theme as well. And overall, as we said, global equities have done reasonably well. I find this quite encouraging in some ways that there are sectors which haven't participated, because that might be future stores of value.
So some examples of those. I mean, the future.
Well, certainly consumer staples. I mean, consumer staples has actually flattered there because one area of consumer staples has done very well, and that is tobacco, believe it or not. And if you recall, back in the beginning of this century, tobacco was probably the cheapest rated sector in the market. But then went on a 15 to 20 year bull run because it was so cheap. And actually, the regulatory environment was all priced in at that stage. So tobacco's had a really good uplift. But things like drinks and food companies, they're being hit at the moment. And some of those companies, despite some of the headwinds they face, are very, very good. And finally, in that sort of ready line at the bottom, healthcare, been very weak this year, basically as the Trump administration has taken the axe to it and wants to cut drug prices in the States. But you can see the impact just recently of the beginnings of a settlement between the industry and the Trump administration, which I think may well provide some good opportunities, and we continue to like that area quite a lot.
Yeah, I suppose if we head into the US political cycle that ever grinds on, next year's a year for the midterms, and people have been avoiding healthcare on the basis that it's politically challenged, and it has been. We've seen, a very small recovery recently as the political news got a bit better. But it's worth just pointing out to everyone that the healthcare sector normally outperforms in a US midterm year, like clockwork, and the average excess return over the market, I think, has been somewhere between 800 and 900 basis points, so 8 or 9% in a mid-cycle US election year. So we'll see how we get on with that. But that's just an example of how you can have a high-quality defensive equity allocation, which frankly has been a bit of a hindrance in the last few months and the last couple of years, but actually, as we look forwards, could contribute quite a lot. I want to focus on another question that we get regularly from clients, though, and people struggle to marry up what we talked about in the introduction, which is a solid but unspectacular economic experience. I mean, that's been the case really for the last 15 years, Richard, hasn't it? Ever since the post-financial crisis years. But at the same time, equities have done really well. And in no small part, they've done really well because their earnings have been spectacular. So how is it that companies can turn a small amount of economic growth into wonderful profits? And can that carry on as we go through the next few years?
Well, there are two really clear ways in which companies achieve this, and a third which is very, very specific to the United States. So the first way is that if companies can make a high and sustainable return on their investments and reinvest their profits in that high and sustainable return, you build this compounding engine within the company, which churns out much higher profits at the end of the process than the inputs from revenues. So if you think of a company growing a little bit faster than the global economic growth in nominal terms, so before inflation, it might be growing therefore at about 5-ish, maybe 6-ish%, which sounds pretty dull, really. But by the time they've churned out those compounded returns, they can quite easily turn that into a 10% double-digit earnings growth story, which is exactly the kind of thing that we like to see. The second factor, of course, is that companies can employ leverage, i.e. they can borrow money. And by borrowing money, particularly when it becomes cheaper to borrow, when interest rates fall, that means the impact of those revenues can be enhanced through that borrowing. And the final point, of course, and here we look at US exceptionalism, is that in the US, we have had a cohort of, quite frankly, the world's best and most astonishing companies for many, many years, for well over a decade. And what this means in the US is that although the valuation and the equity market performance of the US has risen sharply, or to all of our benefits, so has the earnings of the US market, in particular that technology cohort, the likes of Nvidia and Microsoft, Apple, Alphabet, and so on. So the US market has deserved to perform better than the rest of the world because it has been quite exceptional. And despite all the doomsayers in April, continues to churn out outstanding results. And indeed, on the right-hand chart here, you can see that there's some signs that the US itself is beginning to broadening out. So look how earnings progression for US large cap continues to be very strong, but we're finally seeing a good recovery in forecasts for US smaller cap earnings as well. Again, this is really positive, a really positive backdrop for the wider market. And while earnings valuations on the left-hand side, or sales valuations on the left-hand side, do look a bit toppy, as we said, in most of the rest of the world, I wouldn't say they're massively out of range. Towards the top, certainly, but not massively out of range. In the US, definitely a little bit towards the top. So I don't think this is an environment where the alarm bells are ringing because of imminent collapse. It is an environment, I think, which is open to more volatility in terms of market action because you're starting from a high valuation point.
Yeah, so let's get into that for one final bit, and we'll throw it open to questions from the audience, because one of the things that we do within our investment process is we also use external research to help us inform how we should think about portfolios. And whilst we mostly rely on our own instincts, and our investment managers do here as well, and their experience and their understanding of specific investments, it's good to get a sort of sense check from what other people in the industry and the the financial research departments of big banks are thinking. And at the moment, it's interesting because we're dealing with some people who think there'll be a meltdown in equities because of high valuations and because of complacency and markets having performed particularly well. And there's others who think that actually, with the economy doing okay, companies in good shape, companies earning good profits, and the Federal Reserve cutting interest rates, you could see a very strong period for equities. Now, I know we like to try and keep it somewhere in the middle, but there's also people talking about sort of melting down and melting up. So what do you think is going to happen? Is there a case for a meltdown or indeed a melt up or something in between? What do we see in the next 12 months?
So I think it's quite evenly balanced between the two. Let me talk about a melt up. First of all, I'm old enough to
Let's get that one first. We like that one. Yeah.
I'm old enough to remember Alan Greenspan, the then chair of the Fed, uttering the words, equity markets are displaying irrational exuberance. That was in 1996. And he was pointing to what he felt was a high valuation. Now, you could argue that that would apply to US equity markets, certainly today, because valuations, as I say, feel uppy. But of course, what happened between 1996 and 2000 in the US was, with some wobbles, there was a Russia default, Far Eastern debt crisis, and a major hedge fund failure over the next couple of years. But in general, equity markets did melt up, particularly in obviously the famous 1999. And that was driven by technological change, in that case, the internet rather than AI, and by a sense that economic growth was going to continue on pretty much ad infinitum. Some of that you can see being in place today. You've got AI instead of the internet. You've got interest rates in a good place and economic growth coming through. So there's your melt up. Meltdown is purely to do with the valuations on some of the largest tech names, which are pretty high by historical standards, and a sense that if something, a piece of grit gets into that flywheel, then that might stop that rolling compounding up of the returns, which could cause those high valuations to come under pressure, particularly, for example, if we get a surprise on inflation, perhaps driven by tariffs or some outside factor. So because valuations are high, that puts us at risk with some volatility. But I sense that we're in a sort of a balance, and I wouldn't want to be betting one way or the other at the moment.
Yeah, and over the last 3.5 years of working together, I'm sure that our audience and our clients have become bored of us hearing about being diversified, balanced, and open-minded. But that's been the right approach for the last few years, and all of what we've seen. And we suspect it'd be the right approach for the next 3 years, and perhaps even for the next 3 decades, for those who have a very long-term time horizon in front of us. And I think this year is a classic example of why. We've seen a complicated backdrop, we've seen uncertainty, but at the same time, we've seen positive market returns. Sometimes it's right to ignore the noise, ignore the nonsense, be apolitical, and focus on the fundamentals. If you've done that, you've had a positive and rewarding year so far. I think you're right. We think about the sort of melt up and melt down. The meltdown in markets could come around from something around weaker US employment, perhaps some of the tech spending not taking place, or a rise in inflationary pressures, which would mean the Federal Reserve couldn't cut interest rates, which is at the moment suggested as being a positive for markets. And on the flip side of that, if they do cut rates, with the economy still looking like it's okay and markets suggesting that the economy might actually start to improve into ahead of 2026, then I think conditions are set perhaps for an outperformance of equity markets over and above our forecast. So we think it will be somewhere in between, even if that sounds cowardly. So the base case is for a continuation of economic momentum, albeit at a slow pace, inflation starting to roll over again by the end of the year, and some interest rate cuts helping markets. That to us translates into a positive return from equities and bond markets in the next 12 months. Very similar to what we were saying 12 months ago, which at some point in the last year, Richard, this felt a bit more controversial and a bit more painful, but we stick by that view for the next 12 months. But ultimately, we need to recognize it is a difficult, bumpy environment. There's going to be lots of volatility. So we stick by that balanced, diversified, and flexible mindset, even if it's starting to sound quite boring. So over to the questions. And back to you, Richard.
So I'll start on the questions we've had coming through. And so the first one's a very apposite one, given that yesterday, for the first time in history, gold breached the $4,000 an ounce barrier, having been $2,000 an ounce just over 18 months ago. So 100% gain. Outlook for gold, Tom, and more broadly commodities?
Thing that could possibly have gone right for gold has gone right for gold in the last 18 months. Cheap valuations, bad sentiment at the outset. Both of those have translated into obviously a richer valuation and very positive sentiment. That has been fueled by the fact that people are worried about the outlook for the economy. People are worried about the outlook for inflation. People are worried about the direction of the US economy under President Trump, whether that's right or wrong to do so, but that is the nature that people have taken. People are worried about the outlook for longer maturity government debt. And frankly, who can blame them? We agree. Broadly, gold has been the best performing asset around because of, in terms of broad assets, because of all those factors. However, we are now at the point where sentiment towards gold has become stretched. We couldn't argue against taking some profits here. I think that would be sensible. I think we need to recognize, particularly if your position has doubled, you're in a position where your allocation to gold is probably higher than you want it to be, given your starting weight was significantly smaller when gold was much distrusted and much despised. The other factor underpinning the gold price, and this is why I wouldn't sell a whole position and why I'd keep it for longer, despite the fact that it's gone up quite a long way, is we need to recognize the shifting sands of the global geopolitical backdrop. And if you think about it, US government debt has been the safe haven asset of choice for both of our long careers and for much longer before that, since the end of the Second World War. But there are doubts rising over that. Forget the political stuff for a second and focus in on the very simple fact that when countries exported stuff to the US, they were sent back dollars in return. They used those dollars to finance the US government deficit by buying US government bonds. That has now changed in the last 10 years. The Chinese, an example, their holding in US treasuries peaked in the third quarter of 2014, and they've been a net seller of US treasuries over that period. The Russians, an example, sold all of their treasuries heading up to the period when they invaded Ukraine. And just on that, something changed with that invasion of Ukraine and people's attitude towards the US dollar, US treasuries, and indeed gold as an asset itself. Because what countries learned is that the US can change the rules of the game overnight if they want to. So as a response to the Russian tanks rolling over the Ukrainian border, the Americans, somewhat questionably from a legal perspective, froze the Russian overnight assets and seized the assets which they were able to. Now, clearly, a lot of countries around the world took a very dim view of this. And if you're China, as an example, do you really want to refinance the US government's deficit using the dollars they've sent you, when ultimately what they're doing is building weapons to point right back at you? Countries have decided that that's not a sensible idea and have used the recent use of dollars to diversify their balance sheets and to buy more gold. That factor is not going away, and that is relatively price insensitive. So whilst we would advocate that gold has gone a long way, sentiment's become very positive, and there's probably other opportunities in different commodities, we would not advocate not having any exposure whatsoever.
Perfect. I'm going to ask you one more before you can get your own back, Tom, if I may. There's a lot of client concern, I think it's fair to say, and also a lot of interest in our outlook for the pound versus the dollar, given the relative woes of us versus them.
Yeah, and I think you can throw in the Japanese under a new prime minister and the French under whatever prime minister might be in charge today. I mean, it's very difficult to find a currency you particularly want to embrace at this point in time, which makes it very difficult for us to make currency decisions. And ultimately, the reason the US dollar did well in the last decade, before a lot of the geopolitical and political complications, was because it was the cleanest, dirtiest shirt in town. It is no longer that, in our opinion. The shirts are all equally dirty. So we do not believe that there is a case here for a short to short medium term currency trade that is very obvious and easy to make money from, We suspect that the cable rate, that of between the dollar and the pound, will remain relatively constant. But if there is likely to be a move, it is in favor of the dollar on balance, but only by a small amount. Because of the particularly difficult situation the UK finds itself in, and because people are currently very negative on the dollar, less so on the pound. But nothing looks that obvious in currency markets at the moment, Richard. Although having said that, as part of overall balanced portfolios, I think at the moment areas of commodities are attractive, and that's an anti-currency play. But also in a major change versus 10 years ago, it's actually some of the emerging market nations which look better placed. And this is really a change, isn't it, in the last 10 years? And so in our portfolios, we are reconsidering the merits of emerging market assets and looking at as a place to potentially top up.
Absolutely, yes. So that's a marked change over the last several years. And another marked change, I'm going to pick a question for myself now, is the fact that Europe seems to be doing better this year. And we've had a couple of questions in about the durability of that recovery, because we all know that the European economy is in a bad place. We know politically we have the kind of shenanigans we're seeing in France at the moment. Does that make European equities something which is a stayer rather than just a flash in the pan? There's one other thing going on which does help the European story, and that is the one major economy not to have blown its bank balance over the last few years has been Germany, which has the lowest level of debt of the G7 as a proportion of GDP. And they are now going to spend some of that and join the others by going on a big splurge, both on defense, but also on infrastructure in a typical German way. They've sort of said, we'll do the NATO 5%, but a lot of that's going to be spent on upgrading our roads and railways officially, so we can transfer troops and tanks more quickly if needed. But so there's going to be a lot of broad spread, broad spread investment in the German economy. And when I say a lot, we're talking hundreds of billions of euros over the next 5 years. Now, politics is politics. People always mention big numbers and rarely deliver everything they promise. But because of the size of that promise, I still think there's enough of a stimulus to help a bit at the margin. That said, Germany and Europe in general don't have the breadth of outstanding companies that you have in the States to sustain supernormal growth. And the recovery has been quite solid. And I would say now that European assets, having been cheap, are now broadly fair value. So I think it's not that it's completely gone away, just that it's going to be harder work from here. And finally, as our last question, and I'll take this one as well, Tom, you'll be delighted to hear. We've got a question about crypto. Now, in the past, I've not been a fan of crypto, but I am now within Canaccord charged with our approach to crypto investing. This is particularly relevant, and today is a great day to have that question, because the FCA, our regulator, has today, for the first time, allowed retail investors to access crypto, particularly Bitcoin and Ethereum, the two major cryptocurrencies, through what are known as crypto exchange traded notes. But it's effectively an ETF, in broad terms, which can invest in crypto. So will we consider investing in crypto for portfolios? It is a strange time, as Tom has said. Gold has gone to a high it's never seen throughout recorded history in real terms. And crypto, of course, has been an astonishingly strong investment as well. Those two things are slightly linked. And the one thing you can say about crypto assets, they're very volatile. You have Bitcoin now at $120,000. It was down at $30,000 not that long ago, and dropped 75% in its last big sell-off. So they are volatile, but they are also non-correlated assets, particularly non-correlated with potentially weakening currencies. So we are going to looking at introducing the ability for particularly our higher net worth clients to access crypto. It is highly volatile. There's a lot of work to be done on how we categorize the risks associated with it, but watch this space. There will be developments over the next few months in that space. So with that, I said 10:45. It is 10:45. I'd like to thank all our clients and advisors who've dialed in. Thank you for your time. I hope this has been interesting for you. As I reiterate, there will be a recording available. And look out for those invites to our pre and post UK budget webinars, where I think one or two new characters will be on the call to help you navigate some of the implications that may arise as Rachel Reeves tries to fix the fiscal black hole. With that slightly downbeat piece of news, I'd like to thank you again. I look forward to seeing you again. If you have any questions, please reach out to your advisor or account executive. I reiterate and stress it's not just words, it really is heartfelt. It's an absolute privilege to help look after your wealth over the years. So thank you very much, everybody.